Hey guys, Dave Keller here with Market Misbehavior. Today we're going to be talking about the interest rate environment, particularly this rotation from rising rates to falling rates. Rates are actually coming down pretty good while we're recording this on Wednesday, the 15th, which is unusual because you have strong economic data, which usually would mean rates would go up, but rates are actually going down. So what does that falling rate environment mean for the financial sector, for bonds in general, but also for growth versus value and big picture market rotation? Today, we're going to dig into the impacts of falling rates. So I would argue, I often ask people what their one chart would be. And that means if you had one chart to get a read on the overall environment, what would it be right now and why? And for a while, my one chart would be a chart of the 10-year yield, because so much of what we've seen in terms of leadership rotation, growth versus value, relative performance of particular sectors and styles and themes all are driven by interest rates and whether rates are going higher or lower. We've seen this transition from higher rates to lower rates, or rising rates to falling rates, and it's certainly causing some changes. Before we get to the charts and talk about some of the takeaways of the current interest rate environment, I want to remind you, if this sort of thinking about data visualization, charting, technical analysis, and investor behavior is of interest to you, I hope you'll hit subscribe just below the video. Give the video a thumbs up if you could. Put a comment below the video. Tell me where in the market you are most concerned given this inflection point in interest rates. Having said all that, let's get to the charts. All right, so when we're thinking about interest rates, first chart we need to look at is the TLT. This is a good proxy for bond prices, and this is essentially the long bond ETF. What's interesting about the chart of the TLT is this. As bond prices came down in the first quarter of this year and really accelerated from the last 6 months of 2020, you can see that bond prices came down and started to approach the area of support highlighted in this purple box. This is from support from the fourth quarter of 2019. We hit that area a number of times. Finally, this is the springboard for when bond prices accelerated to the upside. This is as stocks were selling off going into the March 2020 low. So the fact that bond prices have bottomed out right around in that same range makes perfect technical sense. What makes even more sense is the fact that you had a bullish divergence between price and momentum. And what that means is prices going lower. So you have lower lows in price, but you have higher lows in momentum. So that tells you that the downside momentum is lessening. There's less, push down on each lower low, and that indicates downside exhaustion, suggests that we've hit support. So the fact that you had that bullish divergence right at price support suggested to us most likely we'd see bond prices go higher, and that's the follow through that we're seeing going into this week. Flip that chart upside down, and that's the chart of the 10-year yield. So this is the $TNX, which is the 10-year yield. You can see, again, rates have gone higher over the last 6 months, really up through mid-March. You can see the opposite of what you saw on the TLT chart, which is a bearish divergence of higher rates February to March, lower RSI, lower momentum. So rates going higher, but less momentum between each upward push. That suggests, just like you suggested, bond prices going up, bond yields coming down, or interest rates coming down. So this drop in yields makes perfect technical sense. What's interesting is it makes perfect technical sense. It doesn't honestly make good fundamental sense, because rates, in general, if economic conditions are improving, rates are most likely going higher. So this week we're getting some strong economic data. Rates should overall be going up, but they're actually going down today. So what that tells me, when there's a disconnect between the technicals and the fundamentals, is that the markets are moving not based on the fundamental thesis, but on something else. It could be a purely technical thesis, maybe just bonds have had such a sell-off. The idea, the theme has could become so bombed out that at some point it bounces, just because it hasn't in so long, but because of that extreme movement. That's a pretty reasonable expectation. Could be just a liquidity event, right? So where people are actually short covering or things like that. It's more of that sort of thing. It's not because of the fundamentals are changing or improving or not improving. It's just because people have to make a structural change in portfolios, and that impacts the chart. But regardless of that, the technicals certainly indicated an end to the rise in rates, at least in the short term, and we're seeing the follow through of that. So let's talk about what implications there are for rates coming down now. The chart of the XLF, this is the financial sector, and it's a busy chart on the top. Sorry, I tried to clean this up, but in general, I use charts more as a notebook than as a picture. So I have a lot of things that I put on charts just to remember what I was thinking at certain times, but I cleaned it up as much as I can. This is the chart of the XLF, the financial sector in the top. The bottom is showing the relative performance of the financial sector versus the S&P 500. So if this line is going up, financial stocks are outperforming the market. When the line's going down, you can see it's underperforming the market. If you look at the chart of the 10-year yield and then look at the chart of the relative performance of the financial sector, they're almost identical, and that makes sense. Financial stocks tend to do better. Banks and regional banks and others tend to do better when rates are going up because that in general is better for their businesses. When rates are coming off, you're going to see financial stocks underperforming. So the underperformance in the financial sector over the last 4 or 5 weeks makes perfect sense given the short-term weakness that we've seen in interest rates. You also see that impacted in overall leadership. So this is the ratio of growth versus value. Instead of using just the regular growth and value indexes, here we're using the RPG and the RPV. These are ETFs that track what are called the pure growth and pure value spaces. So when you, the way that it works is you have a bunch of stocks that are labeled growth and you have a bunch of stocks that are labeled value. Stocks in the middle are kind of growth and kind of value. I usually use the example like a Microsoft. It's an established company, so it's been around. It's more of a blue chip name, so it really is more about value, but also it is still a growth industry and a growth business. In some ways, it kind of has a little of both. So it's actually labeled both growth and value, and it's part of both of those indexes. The pure growth and pure value, ignore those ones that are double counted and show stocks that are just in one bucket or the other. So it's more of a pure read on growth stocks versus value stocks. So the fact that this ratio has gone up over the last month makes sense because value stocks like financials and energy and industrials and materials have not been doing as well in the last month versus things like technology, communication services, internet names, consumer discretionary, and so forth. So what happens when rates come down is financial stocks underperform and growth stocks outperform value. The real question then is what's going to happen next. And, I often ask people what their one chart would be. Like, what's the one chart you want to look at to get a read on the overall environment? My answer for the last month or two has been this chart, the 10-year yield. If you can get a sense of what's happening with yields, you're going to have a really good sense of how to be positioned overall for the market. And the question I would be asking myself as an investor is, do I feel rates are going to be higher or lower from here? Given the strength in the economic conditions, given the overall trajectory in yields, I would say the long-term trend remains positive. I think in general, we're going to see higher rates from here before year end. Between now and the end of the year, I think rates are going to see a higher point than they've seen so far based on the trajectory. But I also think there's a pullback that was overdue and certainly anticipated given the momentum divergences that we've seen on the TLT and the TNX charts that we highlighted earlier in the video. So the question is, what's next? 150, which is this line right here. That's the low that we had in early March. That's also just below the 50-day moving average. Was a really logical stopping point for a pullback in yields. If 10-year yields would bounce off of that level and continue higher, that would probably make the most technical sense. If I was going to draw the idealized chart based on what I've seen historically, that would probably make the most sense. If you break down through that, then we'd have to start doing some other analysis, maybe using the August lows and using the high from about a month ago. That puts us down to like the 130 range, 135 perhaps, and would indicate sort of that as the next support level to look for. But first things first, 150 I would say is that first line in the sand. As long as that holds, I think the overall rising rate environment is still intact. I think you can still see that as a pullback within this longer term uptrend. I think that's a pullback in bonds before, a bounce higher in bonds before the next leg lower in bond prices, and overall supports the fact that economic conditions are still in pretty decent shape. If 10-year yield breaks below 150 significantly, I think you have to really question the overall bullish stocks, everything's good, things are great thesis. That makes you start to question whether we're going to have the support of higher rates and what, not just whether growth is going to outperform, but whether stocks in general can sustain their elevated levels. So that's our discussion about interest rates. And again, this is one of those situations where I feel like the technical and the fundamental theses are a little different, and that's okay. There are plenty of times when the fundamentals and the technicals in the market are aligned. There are plenty of times when they're different, and I found some of the most fascinating times in my career have been when there's a disconnection, because it shows you that there's something there. We're not pricing in the right stories, or our stories are not recognizing the momentum shifts in the market. For me, it's all about looking at a chart of the 10-year yield, as it has been for a while. I think if you get a good read on that chart, you're going to get a sense of sector leadership, on style leadership, and where there may be some opportunities for overall growth in the markets. If this sort of a discussion about charting, thinking about the implications of trend and momentum and investor behavior are of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along on this journey. Give this chart this chart and this video a thumbs up if you could. Certainly appreciate it. And put a comment below the video. What are you seeing with interest rates, and what part of the market do you think is most impacted by rates turning from going higher to going lower? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.